Have you ever wondered why some investors are so keen on dividends? What are they exactly? Well, let's delve into that. Dividends are like a slice of the company's profit pie, handed out to shareholders. You see, when you buy shares of a company, you're essentially buying a tiny piece of that company. And when the company makes a profit, it's only fair that you, as a part owner, get a share of the earnings. That's what dividends are, your share of the company's profits. So, dividends are a way for you to earn from your investments without selling your shares. But how exactly are these dividends paid? Stay tuned as we unravel this in the next segment. Now that we know what dividends are, let's delve into how and when they are paid. To begin with, companies declare dividends. This is the point where a company announces that it will pay a dividend to its shareholders. The announcement includes important details such as the size of the dividend, the record date, and the payment date. Next, let's talk about the record date. The record date is the cutoff point set by the company. Only shareholders who own the company's shares before this date are eligible to receive the dividend. Now, let's move on to the payment date. This is the day when the dividend is actually paid out to shareholders. It's like payday for investors who hold the company's shares. How often are these paydays? Well, dividends can be paid out at different frequencies. Some companies pay dividends monthly. This is common for real estate investment trusts, or REITs. Other companies might pay dividends quarterly, which is the most common frequency. Then there are those that pay semi-annually or annually. It all depends on the company's financial health and dividend policy. So, to recap, companies declare dividends, set a record date, and then distribute the dividends to the shareholders on the payment date. The frequency of this payment can be monthly, quarterly, semi-annually, or annually. So dividends can be a regular income stream for investors. But what motivates a company to pay these dividends? Ever wondered why companies decide to share their profits with shareholders through dividends? Well, there are a few compelling reasons. The first one is to attract and retain investors. Dividends provide a steady income stream, which can be particularly appealing to income-focused investors. It's a bit like a bird leaving a trail of breadcrumbs to attract other birds. In this case, the breadcrumbs are dividends, and the birds are investors. Secondly, dividends act as a signal of financial health. Paying a regular dividend can be a powerful way for a company to showcase its profitability and stability. It's like a peacock flaunting its vibrant feathers, showing off its strength and vitality. Lastly, dividends can also be a way of returning excess cash to shareholders. If a company can't find enough profitable projects to reinvest its profits, it may choose to distribute them as dividends instead. Dividends can be a sign of a company's profitability, but how do you measure the attractiveness of these dividends? When comparing dividends across different companies, one useful metric is the dividend yield. But what is it? Well, let's break it down. Dividend yield is a financial ratio that indicates how much a company pays out in dividends each year relative to its share price. It's calculated by dividing the annual dividends per share by the price per share. So, if a company's annual dividends per share is $2 and its current stock price is $40, the dividend yield would be 5%. This metric essentially tells you the return on investment you would get if you bought the stock today and held it for 1 year, assuming the dividends remain constant. This can be a handy tool for comparing potential income from different dividend-paying stocks. However, it's essential to remember that a high dividend yield isn't always a good thing. It could indicate a struggling company with a falling share price. Knowing the dividend yield can be very useful, but remember, dividends are also subject to taxes. So, you've received a dividend payout, but do you need to pay taxes on it? Well, the short answer is yes, dividends are generally taxable. But how much you'll owe can depend on various factors. For instance, there are two main types of dividends: qualified and non-qualified. Qualified dividends, which meet certain criteria set by the IRS, are taxed at a lower rate than your regular income. Non-qualified dividends, also known as ordinary dividends, are taxed at your regular income tax rate. The tax rate on qualified dividends can range from 0% to 20%, depending on your taxable income and filing status. On the other hand, the tax rate on non-qualified dividends can go as high as 37%. However, it's important to note that these tax rates and rules can change based on your location and specific tax laws. so it's always a good idea to consult with a tax professional. While taxes can reduce your net income from dividends, they can also impact stock prices. You might be curious about how dividends affect stock prices. Well, let's explore that. When a company declares a dividend, it's essentially redistributing a portion of its earnings back to its shareholders. This payout can impact the stock price in two main ways. Firstly, it serves as a signal of the company's financial health. A stable or increasing dividend payout can bolster investor confidence, potentially leading to a rise in share price. Conversely, a cut or omission of the dividend can cause investors to lose confidence, potentially leading to a drop in stock price. Secondly, on the ex-dividend date, the day on which the dividend eligibility expires, the stock price typically drops by about the amount of the dividend declared. This is because the cash for the dividend has been set aside and is no longer part of the company's assets. While dividends can affect stock prices, did you know you can reinvest them? Reinvesting dividends can be a powerful way to grow your investment. Ever heard of DRIPs? Well, let's dive into it. A dividend reinvestment plan, or DRIP for short, is a method investors can use to reinvest their dividends back into more shares of the same company. Instead of receiving your dividends as cash, you'll be given additional shares or fractions of shares. Why would you consider this? Well, there are several benefits. Firstly, it allows your investment to compound over time, potentially leading to significant growth. Secondly, many DRIPs offer shares at a discount, meaning you'll be buying more for less. Lastly, it's a hands-off approach. Once you've set up your DRIP, it will automatically reinvest your dividends, saving you the hassle and the transaction fees. However, as with all investments, it's important to consider your individual financial situation and goals. Reinvesting dividends can be a great strategy, but are these dividend payments guaranteed? As an investor, you might be wondering if dividend payments are a sure thing. While dividends can provide a regular income source, they are by no means a guarantee. Companies have the discretion to reduce or even completely eliminate dividends during times of financial hardship. This is often a necessary measure to preserve cash flow and ensure the business's survival. So, while dividends are a wonderful perk of investing, they should not be relied upon as a guaranteed income. While dividends aren't guaranteed, you can build a strategy around them. If you're interested in harnessing the power of dividends, you might consider building a dividend portfolio. To get started, a key strategy is diversification. Spreading your investments across different sectors can help mitigate risk. You wouldn't want all your eggs in one basket, would you? So, consider industries like technology, healthcare, consumer goods, and utilities. Next, look at a company's dividend history. Has it consistently paid dividends over the years? Steady and increasing dividends often hint at a company's financial health. Additionally, consider the dividend yield, but remember, a high yield might be enticing, but it's not the only indicator of a good investment. Lastly, be patient. Building a robust dividend portfolio doesn't happen overnight. It's a journey, one that involves regular market analysis and adjustments to your portfolio as needed. Building a dividend portfolio can be a rewarding endeavor. Remember, your investment journey is unique to you. We've covered a lot today about dividends, from what they are to how to build a portfolio around them. We've explored the key aspects, from payment methods and timings to tax implications and their impact on stock prices. Remember, understanding dividends is pivotal to making informed investment decisions. And that's a wrap on dividends. If you found this video informative, please give it a like and subscribe to the channel. Your support means the world and enables us to bring you the best financial content. Don't forget to leave a comment with any video suggestions you might have. Until next time, keep investing wisely.